Greetings, everybody. Welcome to Liberty Call. Today is Tuesday, November 28th, 2023. Hope everybody's having a fantastical day out there. Another beautiful day here in Colorado. A little warmer. Still got snow all over my front yard, which I really wish it would go away. But anyways, other than that, it is a fantastic day here. Hope you're having the same. And looks like the market's actually finished in the green. They were kind of going back and forth into the red most of the day. And looks like it pushed enough steam to finish in the green. I don't think the rest of the world is all that great, but actually the Asian markets weren't too bad overnight. But anyways, if it is your first time watching Liberty Call, I'm glad you are here. Yes, you, I'm talking to you. If you could do me a favor, give me some thumbs up, likes, shares, subscribes, follows, press the notification bell, and let's get into today's numbers. Dow Jones was up 0.24%, 83 points, closed at 35,416. S&P 500 up 0.1%, closed at 45,54. NASDAQ up 0.29%, closed at 14,281. The VIX is currently holding at 1269. Canada was up 0.02. Brazil was up 0.64. And Mexico was up 0.27%. In Europe, Germany was up 0.16. The UK was down 0.07. The France was down 0.21%. The Netherlands was down 0.37%. Spain up 0.68%, Italy up 0.12%, Switzerland down 0.56%, and Portugal up 1.13%. Russian exchanges were mixed today. MOEX up 0.17%, the RTSI down 0.3%. And the overnights, the Nikkei in Japan was down 0.11%, Australia up 0.39%. China, the Shanghai was up 0.23%, the Shenzhen Component up 0.49%, China A50 up 0.1%, DJ Shanghai up 0.22%, Hang Seng down 0.83%, and the Taiwan weighted appears to have been closed. All right, so yeah, kind of a mixed day. And let's see what else we got coming up here on the calendar. Let's see here. Yeah, the next Fed meeting's not for a couple of weeks, so I think everyone's just kind of hanging out to see what's going on. You can see my buddy Jake back here. He is quite restless. He wants to go play. It's haven't had a lot of outside time in the last couple of days with all the inclement weather and such. Anyways, all right, let's go ahead and move over to the market recap for today. Dow closes higher as dovish Fed speak dents Treasury yields. Let's see what they had to say. The Dow closed higher on Tuesday, supported by a drop in Treasury yields, fueled by dovish remarks from some Federal Reserve officials, which increased expectations of future rate cuts. Remember yesterday we talked about are rates going to continue to stay where they're at or potentially go up? I actually have an article. We're going to talk about that in a minute. Let's see, rate cuts. The indices are poised to end November with substantial gains, with the Dow Jones up 6.9%, the S&P 500 up 8.5%, and NASDAQ rising 10.8%. The Federal Reserve Board Governor Christopher Waller expressed growing confidence that current monetary policy is well positioned to slow the economy and bring inflation back to the 2% target in 3 years. That's what they're talking about. His comments raised speculation about a potential rate cut in early next year, especially if disinflation persists. We've had zero disinflation, none. We are not below where we were at. We're kind of just stopping where things have peaked out. We haven't had any drop in prices. So let's watch that. Let's watch what we say. Treasury yields fell in response, with the 2-year Treasury yield dropping nearly 12 basis points to around 4.74%, and the 10-year yield declining 6 basis points to 4.33%. Focus on retailers intensified as Cyber Monday sales reached a record high, exceeding $12 billion, according to preliminary estimates from Adobe Digital Insights. The positive consumer sentiment was reflected in higher confidence levels and a surge in shares of retailers like Walmart, Foot Locker, and payment platform Affirm. The latter benefiting from increased usage of buy now, pay later services by holiday shoppers. Yeah, because putting things on credit right now is a very good idea. That's sarcasm if you're not really playing along. In the tech sector, Zscaler cut costs and raised its full-year guidance, while Micron Technology adjusted its profit and revenue outlook for the fiscal first quarter, with a slight dip in its stock as it increased its annual expense forecast. Energy stocks witnessed significant gains as oil prices rose on hopes that OPEC Plus would extend or deepen production cuts at an upcoming meeting. Leading energy companies, including Hess Corporation, Chevron, and EOG Resources, were among the top gainers. Amazon Cloud Business, Amazon Web Services, unveiled a new chip for AI applications, and the company introduced Amazon Q, an AI-powered chatbot similar to ChatGPT, aimed at assisting customers with AWS-related queries. This move follows Microsoft's recent announcement of its AI chip and access to NVIDIA's GPUs on the Azure cloud platform. So, yeah, that's basically it. Why would Amazon name something Q, especially with all the conspiracy crap that's been going on the last few years? I mean, that just, to me, there's not another letter in the alphabet you could have named it other than Q. I mean, seriously. You're going to get all the, Trump tards and, blue anon people who are, they're all both nuts. Anyways. All right, that was everything there. Let's go ahead and dive into this next article. U.S. consumer confidence rebounds. House prices maintain upward trend. All right. U.S. consumer confidence rebounded in November, rising to 102 from a revised 99.1 in October, according to the Conference Board's index. The improvement was primarily driven by an upturn in expectations, although about 2/3 of consumers still consider a recession somewhat or very likely in the next year. Yeah, those people are pretty smart. The overall index exceeded economists' expectations of a dip to 101. Despite the rebound, the President Situation Index, reflecting current business and labor market conditions, edged down, while the Expectations Index, based on short-term outlook, rose. Consumers aged 55 and above were more optimistic, while the 35 to 54 age group expressed less optimism. Probably because the people over 55 are the boomers, and they're getting ready to die, so they're not going to deal with all the problems that they've created over the last 2 or 3 decades with their malfeasance here in the economy and government and everything else. So the sooner they're all gone, the better, in my opinion. Sorry, Dad. Let's see here. The survey also revealed that buying intentions for big ticket items like motor vehicles and major household appliances increased. The share of consumers expecting higher interest rates reached the lowest level since April of 2021, contributing to market expectations of a Fed rate cut in mid-2024. The dollar fell, Treasury prices rose, and stocks on Wall Street traded higher in response to the data. Consumer spending during Cyber Week outperformed expectations, rising 7.8%. The survey also indicated increased plans to buy a house despite concerns about affordability due to rising mortgage rates and a shortage of properties for sale. All right. So, people kind of just, some people are happy, some people are sad, some people's porridge is warm, some it's cold. Anyways. All right. Let's dive in a little deeper on what the Fed might do. Another Fed hike would be unprecedented, but not impossible. It's written by Simon White of Bloomberg Markets. Let's see what he had to say. The market may be underestimating the likelihood of another rate hike by the Federal Reserve, despite the absence of historical precedents. While the Fed last increased its policy rate 18 weeks ago, an extended pause like this is typically rare before another hike. However, given the current restrictive nature of interest rates, the situation is unprecedented. The longest period between the last rate hike and a subsequent increase in restrictive conditions occurred over 14 weeks in 1988. During that period, the yield curve inverted a year before the 1990 recession, and the leading index signaled a contraction 8 months in advance. Despite historical norms, the Fed resumed its rate hiking cycle, taking rates from 8.25% to a peak of 9.75% in 1989. Good times. Today, the potential for stickier than expected inflation might necessitate tighter policy, making current yields appear low as they are influenced by higher short-term rates and persistent nominal GDP. The possibility of another rate hike after such an extended pause challenges conventional patterns. But again, we're not in a conventional pattern. When rates are already restrictive, as they are now, it raises concerns as the historical record lacks instances where the Fed raised rates after such a prolonged period. Actually, rates aren't that high. I don't know why they're getting all, getting their panties in a bunch, because, rates at 5.25%, 5.5% is not exactly extreme. While the economy is different from past cycles, stickier inflation could push the Fed towards a rate hike, influencing yields that may be considered on the low side. The situation prompts a reassessment of expectations, considering the potential for unusual monetary policy moves. The market's underpricing of the probability of a rate hike, despite the lack of precedent, highlights the complexity of current economic conditions and the uncertainty surrounding the future path of interest rates. Investors will closely monitor Fed communications and economic indicators for clues about the central bank's policy stance in the coming months. So according to Mr. White, he would not be surprised to see another rate hike. I actually wouldn't be shocked or surprised either. I also wouldn't be shocked if they cut rates back to zero, because that's been kind of the modus operandi of the last couple decades. Every time there's a little shake in the, a little bump, earthquake or whatever, oh my God, we got to pour money on the problem. And that's why we are where we are today. All right, one last article here. If you got grown kids, this may not be something that exciting. What happens when millions of renters can no longer afford high rents and move back home? Actually, I wouldn't mind the kids being close. Anyways, all right. The current economic environment, characterized by soaring inflation, interest rates, and restrictive central bank actions, has prompted discussions about the potential for a significant economic downturn, challenging the assumption of perpetual stability. Recent bias spanning over 4 decades without a deep recession has contributed to underestimating the possibility of a substantial economic contraction. The last profound recession occurred in 1980 to 1982, marked by elevated inflation, interest rates, unemployment, defaults, and bankruptcies. In contrast to recent decades, the traditional approach of relying on free money airdrops to address economic challenges may be limited due to inflationary constraints. Recessionary periods serve as a catalyst for transformative shifts in societal, financial, and economic landscapes. However, the prolonged absence of a severe downturn has allowed economic excesses to accumulate, challenging the conventional belief in perpetual stability. The article argues that a potential economic downturn could result in a significant exodus of renters from high-rent homes and apartments, similar to the dot-com implosion recession of 2000 to 2002. The current prevalence of high rents across the nation, it's a country, it's not a nation, combined with the spread of high living costs, makes the situation more precarious than in 2000. In the event of a mass job losses and income reductions, millions of renters may be compelled to vacate their apartments, leading to increased vacancies. The analysis questions the commonly held belief of a housing shortage, suggesting that there may be an abundance of housing units occupied by single individuals. The article explores demographic trends, highlighting the increasing number of one-person households, and suggests that some of these units could accommodate additional occupants, challenging the notion of a housing shortage. Well, they're probably alone because nobody likes them. That'd be my guess. In summary, the article underscores the potential for economic challenges to disrupt the current stability, leading to shifts in housing dynamics and challenging assumptions about the resilience of high rents. It emphasizes the importance of considering historical precedents and preparing for the possibility of economic downturns, as opposed to relying solely on recent trends. All right. So that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.